Listen, I don't care if you think gold is too expensive right now. I don't care if your financial advisor told you to stay away. And I definitely don't care about the so called experts on television saying gold is in a bubble. What I care about is your money. And right now, if you're making decisions based on fear instead of facts, you're about to make one of the biggest mistakes of your financial life. I'm Charles Wellington, and I've been trading commodities and precious metals for over 40 years. I've made fortunes when gold soared, and I've lost millions when I ignored the fundamentals. The difference between winning and losing in the gold market comes down to one thing: understanding why gold moves, not just watching it move. Now, before I get into the brutal truth about what's really happening with gold right now, I need you to do something for me. Hit that subscribe button, smash it, because what I'm about to share with you is information that could protect your wealth during one of the most dangerous economic periods in modern history. If you're not subscribed, you're missing out on analysis that goes beyond the surface level garbage you see everywhere else. So do it now. And while you're at it, hit that like button and drop a comment telling me what percentage of your portfolio is in gold right now. I want to know because I guarantee most of you are either overexposed or completely missing this opportunity. Here's the reality that nobody wants to talk about. Gold just went up 64% in 2025. 64%. The S&P 500, it went up 16%. Gold didn't just have a good year. It had an extraordinary year. It crushed the stock market. It crushed bonds. It crushed real estate. And now everyone is asking the same question: is gold about to crash? Let me tell you something. That's the wrong question. The wrong question entirely. Because when you ask, will gold crash? What you're really asking is, should I panic and sell? And panic is how you lose money in any market. The right question is this: under what conditions does gold actually fall? Because gold doesn't crash just because it went up a lot. That's not how this works. That's not how any of this works. Let me show you what people are looking at when they panic about gold. When you look at a 1 year chart of gold, the rise looks steady. It looks almost boring, actually. It's a nice, clean uptrend, nothing scary about it at all. But when you zoom out to the 30-year chart, suddenly people start sweating. They see this massive vertical spike, and their brains immediately scream, bubble. They think it can't keep going up forever. They think gravity has to kick in. They think what goes up must come down. And you know what? They're right about one thing: gold cannot go straight up forever. But here's what they're missing: gold doesn't fall because it's too high. Gold doesn't fall because some technical indicator says it's overbought. Gold doesn't fall because people on Reddit say it's a bubble. Gold falls for very specific, identifiable reasons. And if you don't understand those reasons, you're going to make terrible decisions with your money. Let me give you the history lesson that everyone references, but nobody actually understands. The most famous gold crash in history happened in 1980. Everyone talks about it. Every gold bear brings it up. Remember 1980, they scream. Gold crashed 65%. It's going to happen again. But do you know why gold crashed in 1980? Because I guarantee 99% of the people warning you about it don't actually know. Let me paint the picture for you. Throughout the 1970s, gold surged. Why? Because inflation was out of control. Oil shocks were devastating the economy. Geopolitical turmoil was everywhere. And most importantly, confidence in the US dollar was collapsing. People didn't trust paper currency anymore. They were running to gold because gold was the only thing that held its value while everything else was falling apart. By January 1980, gold peaked at around $850 per troy ounce. That's equivalent to about $3,000 today when you adjust for inflation, and then it crashed. It fell 65%. People lost fortunes. And ever since then, every time gold rallies, someone brings up 1980 as proof that gold always crashes after reaching new highs. But here's what they don't tell you. Here's the part of the story that changes everything. Gold didn't crash because it was too expensive. Gold crashed because Paul Volcker, the chairman of the Federal Reserve, did something that is absolutely impossible to replicate today. He raised interest rates to 20%. 20%. Let that sink in for a moment. Can you imagine having a mortgage at 18% interest? Can you imagine trying to finance a business with interest rates at 15, 18, 20%? Some of you watching this don't have to imagine it. You lived through it, or your parents lived through it. and they'll tell you it was absolutely brutal. It destroyed businesses, it crushed real estate, it caused back to back recessions, unemployment skyrocketed, the economy suffered tremendously. But you know what happened? Inflation was broken, completely and utterly destroyed, and confidence in the US dollar was restored. For the first time in years, holding cash actually made sense. Because when interest rates are at 20% and inflation is at 12%, you're earning a real positive return on your cash. You're not losing purchasing power anymore. You're actually gaining it. That's why gold crashed. Not because it was overvalued, not because of technical signals, not because of some arbitrary price level. Gold crashed because its role as monetary insurance became temporarily unnecessary. When people trust their currency again, they don't need gold. It's that simple. Now let's talk about the other crash that everyone references. 2011. Gold peaked at about $1,920 per troy ounce. This was after the global financial crisis, after multiple rounds of quantitative easing, after the Federal Reserve printed trillions of dollars. Gold surged because people feared that all this money printing would cause massive inflation. But guess what? The inflation never came, at least not the way people expected. Why? Because globalization kept prices down. Weak wage growth kept inflation contained. Excess capacity in manufacturing prevented price increases. And as it became clear that runaway inflation wasn't coming, gold fell. It entered a slow, grinding decline that lasted for years. By 2015, gold had fallen roughly 45% from its peak. But again, gold didn't fall because it was too expensive. Gold fell because the fear that drove it higher never materialized. The insurance policy was no longer needed. When the house doesn't burn down, you don't need fire insurance anymore. That's essentially what happened to gold. So let me make this crystal clear for you. There are three conditions that must align for gold to truly crash. Not just correct, not just pull back 10 or 15%, but truly crash the way it did in 1980 or 2011. First, real interest rates must turn positive and stay there. Real interest rates mean the interest rate minus the inflation rate. When you can hold cash or bonds and earn more than inflation is taking away from you, that's a positive real interest rate. And that's when gold loses its appeal. Second, the US dollar must enter a sustained strengthening cycle. When the dollar is strong, when global capital is flooding into dollar denominated assets, gold typically falls because gold and the dollar have an inverse relationship most of the time. Third, confidence in monetary policy must be restored. People need to believe that central banks and governments have things under control, that they're managing the economy responsibly, that the currency is being defended properly. These three things, that's what it takes. Not technical charts, not sentiment indicators, not some arbitrary price target. These three fundamental conditions. Now, let me ask you a question. Do any of these conditions exist today? Let me walk you through it, because this is where the analysis gets really interesting. This is where you separate the amateurs from the professionals. First, let's talk about real interest rates. The Federal Reserve funds rate right now is 3.75%. That sounds pretty good, right? I mean, it's not zero like it was during the pandemic. It's not 1% like it was for years after the financial crisis. 3.75% feels substantial, but here's the problem. If we calculated inflation the same way we did in the 1980s, using the same methodology, the real inflation rate right now would be somewhere between 6 and 8%. 6 to 8%. The official CPI number they give you, that's been manipulated. They've changed the calculation methodology multiple times over the decades to make inflation look lower than it really is. So let's do the math. Interest rate, 3.75%. Real inflation, 6 to 8%. That means you're losing 2 to 4% of your purchasing power every single year by holding cash. You're not earning a positive real return. You're losing money. Slowly but surely, your wealth is being eroded. This is the complete opposite of what Paul Volcker did. Volcker pushed interest rates far above inflation. He gave you a real positive return for holding dollars. Today, you're being punished for holding cash. And when cash loses value, people run to gold. That's basic economics. Second, let's talk about debt levels. This is the part that terrifies me. In 1980, when Volcker raised rates to 20%, US debt to GDP was roughly 30%. 30%. Can you imagine? The government could afford to pay those massive interest rates because the debt load was manageable. Today, US debt to GDP exceeds 120%. 120%. We have $38 trillion in federal debt. 38 trillion. Do you know what happens if interest rates go to 10%? 15%? 20%? The interest expense alone would consume the entire federal budget. It would be absolutely catastrophic. The government would effectively default. This means the Federal Reserve cannot do what Volcker did. They cannot raise rates high enough to truly restore confidence in the currency. They're trapped. They're boxed in by debt, and the markets know it. Global investors know it. Central banks know it. Everyone knows it, except apparently the people on television telling you that gold is going to crash. Third, fiscal policy remains completely out of control. In 2025, the federal deficit was $1.8 trillion, 1.8 trillion in a single year. We're not at war. We're not in an economic depression. And yet the government is borrowing nearly $2 trillion annually just to keep the lights on. This kind of fiscal irresponsibility destroys confidence in a currency. When you're running massive deficits year after year after year, when you show no willingness to control spending, when every solution to every problem involves printing more money, people lose faith in your currency. And when they lose faith in your currency, they buy gold. Fourth, and this is absolutely critical, central banks around the world are buying gold at record levels. Record levels. Why? Because they're diversifying away from the US dollar. They're reducing their exposure to dollar-denominated assets. They see the writing on the wall. They understand that the dollar's reserve currency status is being threatened. China is buying gold, Russia is buying gold, India is buying gold, Turkey is buying gold. Central banks that have historically held mostly dollars and treasuries are now accumulating massive gold reserves. This creates persistent baseline demand that didn't exist during prior gold peaks. It fundamentally changes the market dynamics. And fifth, de-dollarization is accelerating. Countries around the world are actively working to reduce their dependence on the US dollar system. They're creating alternative payment systems. They're settling trade in other currencies. They're building financial infrastructure that bypasses the dollar entirely. When I look at all these factors together, when I analyze the actual conditions on the ground, I don't see any of the three requirements for a gold crash materializing. Real interest rates are negative. The dollar faces long-term structural challenges, and confidence in monetary policy is deteriorating, not improving. Now, I'm not saying gold can't fall. Of course it can fall. Everything can fall. The question is, what would cause a meaningful, sustained decline in gold prices? What would it actually take? Let me be honest with you about the realistic scenarios, because this is where most people get it wrong. They think in binary terms. Either gold goes to the moon or it crashes. But reality is more nuanced than that. Scenario 1, volatility and consolidation. Gold moves sideways for an extended period, maybe a year, maybe 2 years. The price stays within a range, say between $3,000 and $3,500. It bounces around, frustrates traders, but doesn't crash. This is actually quite common after major rallies. Markets need time to digest gains and build a base for the next leg higher. Scenario 2, sharp corrections within a bull market. Gold could absolutely fall 15, 20, even 25% on some unexpected news or event. Maybe the Fed surprises everyone with a hawkish policy shift. Maybe some geopolitical tension resolves. Maybe technical selling cascades into a panic. These corrections happen. They're violent. They feel devastating when you're in them, but they're not the same as a structural bear market. In a long-term bull market for gold, you should expect and prepare for these corrections. Scenario 3, a true bear market. This is the scenario that would require gold to fall 40, 50, 60%. This is what happened in 1980 and 2011. But for this to happen, you would need dramatic policy changes. You would need sustained positive real interest rates. You would need massive fiscal discipline. You would need the Federal Reserve to demonstrate it's willing to accept severe economic pain to defend the currency. And here's my opinion. That's not going to happen. It can't happen. The debt levels make it impossible. The political system makes it impossible. The entire structure of the modern economy makes it impossible. Could I be wrong? Of course. But based on the fundamentals I'm looking at, a true structural bear market in gold seems highly unlikely. Let me show you something that puts all of this in perspective. We live in a fiat currency system. Every currency in the world today is backed by nothing. There's no gold standard, there's no silver standard. There's nothing backing these currencies except the promise of governments. And historically, every fiat currency in human history has eventually returned to its intrinsic value, zero. I'm not being dramatic. I'm stating historical fact. Every single one, without exception, the Roman denarius, the French assignat, the German papier mark, the Zimbabwean dollar, the Venezuelan bolivar, all of them collapsed. All of them became worthless. Because when you can print unlimited amounts of currency with no constraint, no discipline, and no backing, the inevitable outcome is inflation and currency destruction. Now, I'm not saying the US dollar is going to collapse next week. I'm not saying we're entering hyperinflation tomorrow. What I'm saying is that over the long term, over decades, the structural trend for fiat currencies is down and the structural trend for gold is up. Gold doesn't care about quarterly earnings. Gold doesn't care about central bank meetings. Gold is simply preserving purchasing power while paper currencies lose value. During Germany's Weimar Republic, when hyperinflation was raging, the price of gold in marks went vertical. Yes, there were corrections along the way, sharp, painful corrections, but the overall trend was undeniable. And in the end, the currency collapsed and gold preserved wealth. I'm not predicting hyperinflation in America, but I am pointing out that the fundamental dynamics of fiat currency debasement haven't changed. And as long as governments can print money without restraint, gold will have a role to play. So here's what I need you to understand. Gold does not fall because it reaches new highs. Gold falls when confidence in fiat currencies returns. And that confidence is restored through credible policy, real returns on cash, and fiscal discipline, none of which exists today. Does that mean gold is going straight up from here? No. Does it mean you should put your entire portfolio in gold? Absolutely not. Does it mean gold can't correct 20 or 30% and scare the hell out of you? Of course it can. But what it does mean is this. The historical comparisons to 1980 and 2011 don't hold up when you actually analyze the conditions. The environment is fundamentally different. The constraints on policy are fundamentally different. The global monetary system is fundamentally different. Now, I want you to do something for me. I want you to take action based on this information, not panic, not speculation, action based on analysis. First, assess your current portfolio. What percentage is in gold? What percentage is in cash? What percentage is in stocks and bonds? Are you properly diversified? Or are you overexposed to paper assets that could lose value if currency debasement continues? Second, educate yourself on real interest rates. Don't just look at the nominal interest rate. Calculate the real rate by subtracting actual inflation. If you're losing purchasing power, that's a problem, and gold solves that problem. Third, ignore the noise. Turn off the television. Stop listening to financial advisors who have never traded gold and don't understand the fundamentals. Stop reading headlines designed to generate clicks and create fear. Focus on the data. Focus on the fundamentals. Fourth, have a plan for corrections because they will happen. When gold falls 15%, are you going to panic and sell? Or are you going to recognize it as an opportunity to add to your position? The answer to that question will determine whether you make money or lose money in this market. And fifth, think long term. Gold is not a trading vehicle for most people. It's insurance, it's wealth preservation, it's protection against currency debasement and monetary chaos. If you're buying gold thinking you're going to double your money in 6 months, you're doing it wrong. If you're buying gold as part of a diversified long-term strategy to preserve wealth, you're doing it right. Here's my challenge. I want you to commit right now to educating yourself on monetary history. Read about the gold standard, read about fiat currencies, read about what happened in Weimar Germany, in Zimbabwe, in Venezuela, in Argentina. Understand that what we're experiencing today is not new. It's happened many times throughout history, and every time gold has preserved wealth while paper currencies have collapsed. I want you to stop relying on other people to tell you what to think. Do your own research. Look at the debt numbers. Look at the deficit numbers. Look at central bank gold purchases. Look at de-dollarization trends. The information is all publicly available. You just have to be willing to look at it honestly. And I want you to take action, not reckless action, not emotional action, but deliberate, informed action based on facts and analysis. If that means adding some gold to your portfolio, do it. If that means reducing your cash position, do it. If that means repositioning your investments to protect against currency debasement, do it. The worst thing you can do is nothing. The worst thing you can do is stick your head in the sand and hope that somehow everything will work out. Hope is not a strategy. Hope is how you lose money. Now I need you to do something else for me. If this analysis has opened your eyes, if you're starting to see the gold market differently, if you understand now why the comparisons to 1980 are fundamentally flawed, I need you to hit that like button right now. I need you to subscribe to this channel if you haven't already. And I need you to drop a comment below telling me your thoughts. Do you agree with this analysis? Do you think gold is headed higher? Are you concerned about a correction? What percentage of your portfolio is in gold? Tell me, because when you write it down, when you articulate your thinking publicly, you're more likely to follow through with your plan. This channel exists to give you analysis that cuts through the nonsense. I'm not here to make you feel good. I'm not here to tell you what you want to hear. I'm here to tell you what you need to know, even when it's uncomfortable, even when it challenges conventional wisdom. The truth is this: if you're making decisions about gold based on fear instead of fundamentals, you're going to lose money. If you're comparing today's environment to 1980 without understanding what actually caused gold to crash back then, you're going to make mistakes. If you're listening to people who have never studied monetary history and don't understand the role of gold in a fiat currency system, you're getting terrible advice. But if you're willing to look at the data, if you're willing to understand the fundamentals, if you're willing to think for yourself instead of following the herd, you can make intelligent decisions that protect your wealth. Gold doesn't crash because it's too expensive. Gold crashes when specific conditions align, and those conditions don't exist today. That doesn't mean gold can't correct. It doesn't mean volatility won't be terrifying at times, but it does mean that the structural case for gold remains intact. So stop making decisions based on fear. Stop listening to people who don't understand the market. Start thinking critically. Start analyzing the fundamentals. Start making informed decisions based on facts instead of emotions. Your future self will thank you. Your family will thank you. Your portfolio will thank you. Now get out there and make intelligent decisions with your money. The information is here. The analysis is here. All you have to do is use it. And if you want deeper analysis, if you want to see exactly how I'm positioning my own portfolio, if you want access to exclusive content that goes even further than what I can share publicly, check out the link below. Join the community of serious investors who understand that wealth preservation requires knowledge, discipline, and action. Thank you for watching. Thank you for being part of this community. Now go out there and protect your wealth. The monetary system is changing. The dollar's dominance is being challenged. Central banks are buying gold at record levels, and you have a choice. You can recognize what's happening and position yourself accordingly, or you can ignore it and hope for the best. I know which choice I'm making. I know which choice the smart money is making. The question is, which choice are you going to make? Hit that subscribe button, become a member, and let's continue this journey together, because in the months and years ahead, understanding gold and understanding monetary dynamics is going to be absolutely critical to preserving wealth. Remember, markets punish ignorance and reward knowledge. Make sure you're on the right side of that equation.